Every year, many Canadian companies undergo the process of merging with or acquiring other companies, driving growth and expansion. Whether these transactions are domestic or global, several tax considerations come into play, making it necessary to be well informed on the tax implications of these deals. For businesses in Canada, understanding these implications is a key aspect of successfully navigating the process of mergers and acquisitions. I explore the main tax implications in Canadian business mergers and acquisitions, highlighting key points for sellers and buyers. To understand the tax implications, it's important to first establish the types of transactions involved in mergers and acquisitions. The main types of transactions are asset purchases and share purchases. Asset purchases involve the acquisition of the assets of the target company, whereas share purchases involve the purchase of shares in the target company. The tax implications for each type of transaction are different and will be discussed in the following sections. In an asset purchase, the primary tax implication for the seller is the capital gains realized through the sale of assets. In Canada, capital gains are subject to taxation, with 50% of the capital gain included in the taxable income. However, the tax consequences for sellers may be mitigated through rollover provisions or other tax-reducing strategies available under the Income Tax Act. From the buyer's perspective, one of the main tax advantages of an asset purchase, compared to a share purchase, is the potential to establish the purchaser's cost basis in the acquired assets. This means that the buyer can allocate the purchase price among the various assets based on their fair market value. Consequently, the depreciation and amortization claimed by the buyer may be higher, resulting in potential tax deferrals. Buyers may avoid inheriting some of the tax liabilities of the target company as they are purchasing the assets and not the shares of the company. When selling shares in a company, the seller's primary tax implication is the capital gain realized from the sale of shares. Similar to an asset sale, 50% of the capital gain is taxable. An important tax consideration for individuals selling shares of a qualifying small business corporation is the lifetime capital gains exemption, LCGE. The LCGE is an exemption available to Canadian shareholders, allowing them to potentially receive up to a certain amount of capital gain realized on the sale of shares tax-free, thereby minimizing the seller's tax liability. The LCGE amount is subject to revision and must be verified as per current regulations. In a share purchase transaction, the buyer acquires the target company's shares, resulting in the inheritance of the company's historical tax attributes, including any tax liabilities. One of the challenges faced by the buyer in a share purchase transaction is establishing a cost basis for the acquired assets. Unlike the asset purchase, a share purchase does not allow for the bump in the cost basis for assets, potentially limiting the ability to claim depreciation and amortization. Another tax consideration for buyers in a share purchase transaction is withholding tax. When acquiring shares in a Canadian company from a non-resident, a buyer may be obligated to withhold and remit a portion of the purchase price as per the Income Tax Act. Depending on the circumstances and the applicable tax treaties, the rate of withholding tax can vary. To avoid future tax liabilities or penalties, buyers must ensure they are in compliance with these withholding tax requirements. During the mergers and acquisitions process, it is essential for both buyers and sellers to carry out thorough tax due diligence. Tax due diligence allows the parties to identify potential tax exposures, missed tax-saving opportunities, compliance issues, and contingencies that may affect the transaction value. Many issues uncovered through tax due diligence could be addressed through negotiations or adjustments to the purchase agreement. Furthermore, tax due diligence can help minimize unanticipated tax liabilities arising from the transaction.